A currency war does not look like a war. There are no tanks and no borders moving on a map. It looks like a quiet meeting at a central bank, a short statement from a finance minister, and then a number on a screen shifting a few percent. Yet that small move can decide which factories stay open, which jobs survive, and which countries feel too expensive to the world. The core idea is simple. If your currency becomes cheaper, your exports become cheaper to foreigners. If your currency becomes stronger, your exports become more expensive. That is why governments watch exchange rates so closely. They are a shortcut into real life, jobs, prices, and political stability. A currency war happens when countries compete to weaken their currencies, or when one country's move forces others to respond. It is rarely about national pride. It is about pressure. If your neighbor suddenly sells goods more cheaply because their currency fell, your own industries feel squeezed. Leaders then face calls to protect jobs. To make this easy, treat the exchange rate like a price tag between two currencies. If one unit of your currency buys fewer units of foreign currency, your currency is weaker. Foreign buyers can then purchase your goods at a lower effective price. Exports can rise, factories get more orders, and unemployment can fall. But the same weakness raises the cost of imports. Fuel, food, medicine, and machine parts can become more expensive. So a weaker currency is a trade-off. It helps exporters while it hurts importers and consumers. Why do people call it a war? Because one country's advantage can look like another country's loss. If country A weakens its currency and export sales surge, country B may lose orders. B may accuse A of cheating, especially if it believes the weakness was intentional. That accusation is the start of currency war politics. Not every currency move is a war. Exchange rates move for many reasons: inflation, interest rates, growth, political stability, commodity prices, and investor fear. A currency war is a pattern of competitive moves where governments and central banks watch each other and react. To understand the battle, you need the main weapons. Weapon 1 is interest rates. When a central bank cuts rates, investors often earn less by holding that currency. Money may flow out toward higher-yielding places. That can weaken the currency. Central banks cut rates mainly to support domestic growth, but they know the exchange rate will respond. Weapon 2 is large-scale bond buying and money creation. When a central bank creates money to buy assets, long-term rates can fall and credit can loosen. That can weaken the currency because investors search elsewhere for higher returns. Officials describe this as fighting recession or deflation, but the side effect can be a cheaper currency. Weapon 3 is direct intervention. A central bank can sell its own currency and buy foreign currency. That increases the supply of the home currency in the market and can push it down. This is the most direct, we want a weaker currency tool. Weapon 4 is communication. A government can talk its currency down. A single comment like, "Our currency is too strong," can shift trader expectations. In currency markets, expectations move prices quickly. Weapon 5 is restrictions in trade policy. Tariffs, export subsidies, and capital controls are not exchange rate tools on paper, but they influence currency flows and competitiveness. They can trigger retaliation just as surely as a rate cut. So why do currency wars happen? Usually after a shock. When growth is weak, unemployment is high, and voters are angry. Leaders look for faster ways to support jobs. A weaker currency can feel like a shortcut because it boosts exporters and tourism without years of reform. It is also politically easier than cutting domestic costs. Instead of asking wages to fall, you try to change the price of the currency. This creates the classic problem. You cannot all devalue at once. If every country tries to push its currency down, relative prices do not all change in a helpful way. Someone's currency must be strong compared to someone else's. So the attempt becomes a race, and the damage shows up elsewhere. Higher inflation from pricier imports, unstable capital flows, and rising trade hostility. History shows why this becomes dangerous. During the Great Depression, many countries devalued to make exports cheaper. Some recovered faster, but the overall result was less trust. Trade barriers rose, cooperation fell, and the global economy became more fragmented. Competitive devaluation can offer short relief, but it can also poison coordination when coordination is most needed. In the modern world, currency conflict often begins when a major economy changes policy, and the shock spreads worldwide. Imagine a large economy raises interest rates sharply. Higher rates attract global capital. Investors buy that currency to earn the higher yield, and the currency strengthens. For other countries, that can be painful. Their currencies weaken, imports cost more, and debts priced in the stronger currency become harder to pay. Some respond by raising their own interest rates to defend their currency, even if their domestic economy is weak. In this way, one country's tightening can export financial stress to others. Now, reverse it. Suppose a major economy cuts rates and floods markets with liquidity to fight a slump. Investors may search for yield elsewhere, sending money into smaller economies. Those inflows can push local currencies up, making exports less competitive. Leaders may intervene to stop the currency from rising too much, or they may impose controls to slow inflows. The conflict is not always one villain versus victims. It is spillovers forcing reactions. Economists sometimes use the phrase beggar thy neighbor. It means improving your own situation by pushing problems onto others. In currency terms, it means using devaluation to pull demand away from trading partners. If many countries try it, accusations rise and relationships sour. But weakening a currency is not free. It raises import prices. If a country imports fuel, transport costs rise. If it imports food, daily life gets more expensive. If it imports machinery, local business costs rise. That inflation can become political anger. So leaders must balance export support against consumer pain. There is also a credibility cost. If markets believe a country is weakening its currency on purpose, investors may fear higher future inflation or sudden rules that trap their money. Long-term investment can fall. In other words, if you weaken the currency by damaging trust, you may gain a short boost but lose a stable future. Here is what this looks like on one street. Picture two businesses side by side. One is an exporter. It sells coffee, textiles, or software. Services to foreigners. The other is an importer. It sells fuel, medicine, or spare parts brought from overseas. When the currency falls, the exporter receives more local currency for each foreign sale. The exporter feels relief. The importer pays more to restock shelves. The importer raises prices. The public blames the shopkeeper, but the root cause is the exchange rate shifting underneath everything. Now, zoom out to the government. If leaders focus only on exporters, they may celebrate a weaker currency. If they focus only on consumers, they may fear a weaker currency. A country that imports most of what it consumes cannot devalue easily without inflation. A country that exports a lot may tolerate weakness longer. That is why currency wars feel different in different places. So what does a currency war look like in real time? Step 1. A country faces weak growth. It cuts rates. Its currency falls. Exporters cheer. Consumers notice imports cost more. Step 2. Neighbors feel pressure. Their exporters lose competitiveness. They respond by cutting rates too, intervening or complaining publicly. The market senses competition and volatility rises. Step 3. Politics heats up. Leaders accuse each other of manipulation. Trade threats appear. Companies delay investment because currency costs become unpredictable. Step 4. The cycle ends in one of three ways. Growth returns and pressure eases. Inflation forces central banks to tighten, lifting currencies again. Or governments coordinate through agreements that stabilize expectations. One key point makes modern currency wars sharper than old ones: finance. Today, most cross-border money movement is not a company paying for imports. It is investors buying assets, bonds, stocks, and property. If a country offers higher interest rates, money can pour in and raise the currency quickly. If investors fear political risk, money can flee and crash the currency. These swings can be larger than trade flows. So the war is partly fought by global investors, not only governments. This is why sudden moves can be brutal. A currency can rise fast during a flight to safety, crushing exporters overnight, or it can fall fast during panic, forcing import prices up before wages adjust. The exchange rate acts like a shock absorber, but sometimes it absorbs the shock by passing it straight into household budgets. Some governments try to reduce the damage by building foreign exchange reserves, like a household building savings. If their currency comes under pressure, they can use reserves to buy their own currency and slow the fall. This can prevent panic. But reserves are finite. Defending an unrealistic exchange rate can burn reserves quickly. Once markets sense the defense is weak, speculators push harder. That is why fixed pegs often fail dramatically. Others try to stabilize through rules. They allow the currency to move, but they try to keep inflation low, budgets credible, and banks stable. Over time, that builds trust. And trust is a powerful currency policy. A trusted country often experiences less violent swings. To reduce conflict, countries sometimes coordinate. They meet, share information, and promise to avoid extreme moves. Coordination is hard because every country has its own election cycle and its own pain points. Still, when coordination works, it can calm markets by making policy more predictable. One more lesson comes from coordination deals. Sometimes major countries decide the exchange rate has moved too far and they want a calmer path. They meet, agree on goals, and signal that policy will lean the same way. Markets react quickly because traders price the new direction early. Coordination can work because it reduces uncertainty. Businesses can plan, and investors stop betting. The opposite case is a warning. If a country promises a fixed ceiling or floor for its currency, markets will test that promise. The central bank must spend reserves or change interest rates to defend it. If the defense becomes too costly, the bank may abandon the promise. When that happens, the currency can move violently, surprising exporters, borrowers, and banks. The takeaway is simple. Stability promises are powerful, but breaking them is expensive. So what is the best way to think about currency wars? Think of them as a fight over demand in a world with limited growth. When the global economy is strong, countries can grow together. When the global economy is weak, leaders try to pull demand toward themselves. The exchange rate is one lever. But if everyone pulls at once, the rope frays, volatility rises, inflation risks increase, and cooperation weakens. The long-term answer is not endless devaluation. It is productivity and credibility. Countries with strong institutions, stable policy, and competitive industries do not need constant currency tricks. They can succeed even with a stronger currency because their products and services are valuable. The practical lesson is also simple. When you hear currency war, ask two questions. First, is the currency moving because of domestic policy choices or because global capital is chasing interest rates and safety? Second, who pays the cost, consumers through higher import prices or exporters through lost competitiveness? Currency wars are not fought with bullets. They are fought with rates, reserves, and reputation. And like all conflicts, the people who feel the impact most are usually the ones who never sat at the meeting where the decision was made.